Yo, 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 yo. Happy Fed Day. Wait, is that money in here? Oh, I can't get it out of the way. I can't even see. Let's go. So, hey, happy day. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So what's going on? You guys fired up? Nothing like a Fed date. Oh, I guess the webcam's all weird. I guess I got to sit back here. Oh, yeah, that's right. I had to move this back because the light burned out, and I just don't have time to deal with it. Apparently, I don't even have time to comb my hair. Oh, well, I apologize for that. So, hey, by the way, my name is Wayne. I am the Chief FX Market Strategist for TradersWay.com. Thank you very much for being a client. We appreciate you. I work hard for you. I know you work hard for me. And together, we will help you find success. Technically, fundamentally, psychologically. I give you big pictures as far as how to maybe think in an esoteric point of view about what Forex is and what it can be, and which could be dramatically different from where you started when you found Forex. And then I try to teach things like, technical analysis, and then fundamentals, and then a bunch of other things. But if you put them all together, they're all the tools that you need to succeed. Now, the nice thing is, I don't think Forex is really that complicated. I think we're complicated. So when I teach you like technical analysis, it's basically some pivot points, some price action, right? And then I use some oscillators sometimes, some moving averages sometimes, but they all kind of just tell you the same thing as well. So it gives you a couple of different points of view, but none of them are really that complicated. Okay. But being a trader is complicated. Making decisions is complicated, but the technical analysis just simply puts you in and takes you out of trades, but they don't tell you what to do. So anyways, if these webinars are starting to help, or if you just simply like to have the community every day, make sure you pay it back. Let Traders Way know that you care. Visit tradersway.com, open an account. The demo is fine. And over time, they hope to earn your loyalty and respect, and that one day you will successfully trade with real money. My hair was sweaty. Yeah. No, it's not bad, right? I used to be pretty. That's the thing. I used to be pretty. Anyway, so visit Traders Way. Couple of other things, while we get things going as far as house cleaning here. In the video description below, there's a link to download all my chart templates for free. Cool. Okay. That's nice, right? Please like, please subscribe, please comment. Now, why would you subscribe to the channel? Well, when I click stream, YouTube is supposed to notify you from the fire of your screen. You don't like the fire? Okay. Now, some people say YouTube doesn't do a consistent job of that. So if you want, you could also visit twitter.com/FXBootcamp. Okay. If you do that and what do they call it? Follow, whatever, subscribe at Twitter, whatever. When I click stream, it also sends out an automatic notification So you can do it that way. Thank you, baby doll. Thank you, Stacey. Is it Sav Sav? Thank you, Sav Sav. Appreciate it. So there's a lot I'm trying to offer you. So I'm here every single day, thanks to Trader's Way. I've written a book about how to trade Forex because it's just literally another medium that I can offer help to people. I've created dozens of hours of training, video training courses. You can get that at fxbootcamp.com. I've also launched a live training program where a real human being with real emotions and real intellect and real experience will rock your world and open your eyes to the trader that you can be. But it's a true boot camp. It will rock your world. It's not something you like dabble in. Oh, let's go to boot camp and see how Army is like. I think I'll join the Army, and if I don't like it, I'll just become a real estate agent. No. It's pretty serious. So if you're ready for that, there's that resource. But so thank you to Trader's Way for making this happen. And if there are anything other things that I can do for you to help you succeed, please let me know. And with that being said, we have a Fed day today. So there might be some jostling for position. I wouldn't bet the farm today in the New York session, and nor would I bet the farm on the Fed meeting. So there is absolutely no reason for the Fed to cut interest rates. But that's what's being priced in right now. And it's very bothersome for me because, well, what if they actually do cut interest rates or actually say they're going to cut interest rates? I actually find this to be a problem. Jerome Powell is not an economist. Okay? Oh, Oscar, if you're going to ask me a question like that, you got to pay me money. You're asking me for my opinion, and then, of course, my opinion to back it up with, like, I'm sure some fundamental analysis and stuff. I'm not going to tell you what my opinion is for the Aussie for the rest of the year. Because most likely when people ask me that question, then they turn and they say that's their opinion for the Aussie the rest of the year. Like, yeah. But I'll go over the Aussie today, and you can tell me if you're a bull or a bear, and I can review the charts from your point of view. That I can do. Okay? Now, where were we? Oh, the Fed. There's absolutely no reason to cut interest rates unless you're trying to make Wall Street millionaires, help them go turn into billionaires. And the interesting thing is, if it were a true economics nerd, someone with 2 PhDs in economics, there's no way they would cut interest rates. And people will say, oh, well, you got to help us. You know, Trump's got the trade war. We got to get, like an economist would say, you know what? I don't give a damn. Not my problem. Right? What does the Fed do? Monetary policy. What does that have to do with anything else, right? So the Fed's got, the federal government has a trade war with various governments around the world. Great. All right. So the Fed won't raise interest rates further, right? You know what I mean? So anyway, so going all the way back today, like, what if they're right? What if Jerome Powell leads a Fed in such a way that they respond to market conditions? Right? What if that's going on? Yeah, and Brooke brings up a point. They're not even just pricing in one rate cut. They're pricing in many. 2, 3. Right? Like, oh my gosh, right? So that's sort of the scary thing. What if the new Fed doesn't look at the economics, they look at the market? Stock market's down, cut interest rates. What? By the way, the stock market isn't down, right? Like, oh my God. gonna rock your world. Yeah. So, anyways, guys, that's me. Oh yeah, I was playing with this. I don't know if you noticed that. Isn't that nice? Nice. Yeah. Anyways. Very, very dangerous if we get into that situation. But I'm sure there's plenty of Goldman Sachs, senior executives on their hands and knees going, please cut interest rates, right? Because they're not making money giving, mortgage loans to people. They make money other ways. So anyways, very interesting times to be alive. And it's one of these things where if you ask me as an economist, what's going to happen today? Well, we are full employment, stock market's up, right? Well, isn't that the two things that the Fed's supposed to worry about? Full employment, asset prices. Oh, well, they're both at all-time highs. Great. We shouldn't cut interest rates, right? Right? So if they do, holy smack! That's going to be interesting. Now, it seems like if you're reviewing macroeconomics, central banks around the world are cutting, and that's interesting. Yes, the U.S. economy is definitely slowing down. It's not declining though. It's not contracting. Okay, it's not below 50, so to speak. But it's slowing down because we are in a trade war, and that's expected to happen. And then when we're not in a trade war, all these things are going to go back up. So what are we going to do? Cut interest rates for a year and then raise them again? That's a very, 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 very dangerous. It's sort of like an amateur trading Forex. There's no long-term plan. You're not even thinking about next month. You're just walking into today going, what should we do today? Should I be a bull today or should I be a bear today? Okay? See what I mean? So that would be a terrible thing. And for those that don't like the Fed in general, that would be just crazy. I like the Fed. I think they've done a lot of good. I don't think they're perfect by any means, but doing that would be also very, very bad. So long story short, I don't know what the heck's going to happen today, so you need to be careful. By careful, I mean either not trade or definitely write it down. Do not bet the farm. Like I would actually have you, if we let's say we're all in a room together. So I'm running a hedge fund, and you're my traders. And I come out and I have everyone stand up, and I have everyone raise their hand. Repeat after me. I am a conservative and disciplined trader. I am a conservative and disciplined trader. I have a long-term point of view. I have a long-term. Today is just another day. Today, I will stay conservative. I will stay disciplined. I will not lose a lot of money today. I will not guess. I will not chase. I am not a degenerate gambler. And then I'll say, okay, everyone sit down. I'll say, okay, thank you for going through that with me. By the way, if you lose a lot of money today, I'm pushing you out the window. There's only one way out of this office building. Or there's only two ways out, right? One, in an elevator full of gold. Two, out the window. So anyways. Hoorah! But it's true. It's absolutely true. Do you think if someone was reviewing your trade history and you showed them 2019, do you think they'll go to whatever date it is, 20th? 19th. Do you think they'll skip right to June 19th and check out what you did today? There's been some really great, nice little trades going into this. And then today is really, could be a nothing day. Whatever you do, don't make it a day that will be memorable. Don't make it a day that will stand out if someone looked at your trade history. They're like, oh my God, what happened June 19th? Oh, well, I bet the farm and I got lucky. Well, if that happened, someone won't invest. Do you understand that? Even if you made a lot of money, they'll look at it and go, oh my God, you did what? Oh, I bet the farm and I made a lot of money. What's the other scenario? You lost a lot of money. And they're like, oh my God, you lost a lot of money? And then you're dead either way. You understand that? You're dead either way. So either take nice, really conservative, obvious trades, maybe after the volatility and all that kind of stuff, or don't trade at all. But like trading here, for example, and leaving your stop at break even might be the best way to play a Euro USD short. And it either does this today or it does this today. What happens? Well, you lose nothing today and you lose nothing yesterday. Huh. Well, that's really terrible. Oh my God. What are you going to do? Right? But let's look here. You sold here, and you sold here, and you sold here, and you sold here, and this one didn't work out. Well, or just sat there break even, and then you sold there, and now you're thinking maybe I'll sell here or here, and the news comes out and like, oh my God, the Fed's going to cut. Boom, Euro USD goes like that, and you lose no money this week. So I guess what my point is going into high volatility event news, especially when you believe there's a reasonable chance, or let's say not even a chance, the market expects a reasonable chance of a fundamental or policy change. How do you trade it? Days in advance. Okay? Days in advance. You trade it a week early. Okay? Wednesday, Tuesday, Monday, Friday, Thursday, Wednesday. So you could sell it last Wednesday, last Thursday, last Friday, and yesterday. And have 3 of them locked in at least 50 pips each. And you got the last one at break even, your hero or zero. And I'll tell you what, if it goes your way, this thing's going to drop 100 pips today because the Fed changed or didn't change or did whatever, and the market drops, and now you're going to make 200, 200, 150, 150, 100, 100, and you walk out with your yellow Lamborghini. So if they cut, I would expect this to go up. If they don't cut, or remember, it's not that they do anything. They signal. It's kind of like game theory. They signal. Like the best signal I've ever seen in the history of the world was Draghi, actually. Mario Draghi. He was a very young president of the ECB, the Governing Council. Which is a great name, right? The Governing Council. Which council? The Governing Council! Oh! And he sent a signal, and this is right out of game theory, actually. Signaling is a way to influence the other player's move. So he bailed out Greece without spending a euro. Fantastic. So anyways, if there's some sort of signal like, hey, we're seriously thinking about cutting interest rates, boom. Then euro dollar goes up. If they're like, there's no way in hell in these market conditions we're going to raise interest rates, boom. Now, have you gone as far as to read transcripts from speeches and stuff? The way I've interpreted Jerome Powell's recent speeches is he's not going to do it. So I don't know where everyone gets their opinion, but I guess that's why they have their opinion. But like he spoke at the what was it? The Economic Club of New York, maybe, when was that? A month ago? About a month ago? And the way I interpreted, he said a couple of things. Of course, I can't remember exactly what he said, but here's my interpretation of it. He's not asking for a rate cut. He's not thinking about a rate cut. A rate cut, what would a rate cut even do? Okay. So for example, let's say oil prices are down. Let's just forget about supply. Let's just say oil prices are down because economic activity has slowed, so demand for energy has slowed. And this has to do with a trade war between the United States and the rest of the world, quite frankly, right? The largest economy in the world versus everyone else, including China. But it's other players, right? Canada, Mexico, Europe, like everybody's in on this, right? And Japan. So it's a global slowdown based on what? The trade war? Okay, so let's analyze that then. Clear. There's a trade war, and that slows economic activity. So cutting interest rates, what would that do? Well, how do you cut interest rates? You increase money supply. All right, so we increase the amount of dollars in the world economy. So the US dollar now loses value because, as we know, right, here's demand, here's supply. You increase supply to S2, and the price of a dollar goes from P1 to P2, and it falls, right? So an increase in the number of dollars decreases the value. So the US dollar falls. Okay, great. How does that impact here? Is economic activity slowing because the dollar's too expensive? Is that what's going on, guys? They're like, wait, people want to visit America, but it's too expensive because the dollar is too expensive. And if you convert, then hotels are way too expensive and food is way too expensive and all that kind of stuff. Or they want to buy American products, but they're like way crazy over expensive, especially when you tie in the exchange rate. Is that why the global economy has slowed down? Well, no. So how would an increase, okay, this is an increase in quantity. So you can do it, again, you can do it this way. The quantity of money and the price of money, okay? So if you go from supply 1, which is, we'll do Q1, to Q2, supply 2, which I'll label Q2, okay? Can you see it increased from, let's say, 1 trillion, 2 trillion, 3 trillion, 4 trillion, 5 trillion, 6 trillion, 7 trillion, 8 trillion, 9 trillion, right? So we went from this number to this number. That's why this is an increase in the supply of actual dollar bills floating around, or at least ones and zeros on computers. How would that impact the trade war? Well, it wouldn't. Oh. So do you think the Fed is smart enough to know that? Do you think they've looked at supply and demand charts for open economies? So by the way, if demand is constant, right, here's how we get here. P1 was the value of these dollars. And now it's P2, as I just showed you. So the quantity of money goes up and the value of the money goes down, right? So, why would the Fed increase money supply? Now you say, well, Wayne, what does this have to do with money supply? Oh, okay, let's do that then quickly. How does the Fed lower interest rates? Fed lower, let's do percentage down. Okay, how does the Fed lower interest rates? Do they pass a law? This is the Federal Reserve Bank of the United States, and we pass a law to look. No, actually, the Fed doesn't have the power to pass a law, only Congress. Well, they create the law, and it still has to be, right? But anyways, the Fed doesn't create laws. So how do they get every bank in the United States to lower interest rates? Do they call them and like, hey, JP Morgan, hope you're having a nice day. How you doing? Okay, great. Yeah, this is JP over at the Fed, and well, we'd like you to lower your interest rates, right? No. So they go into the market. So these are called open market operations, and this is done specifically by the New York Fed. That's why the president of the New York Fed always is a voter. Now, not all. Now, out of the other, 11 Federal Reserve banks, they rotate voting, non-voting. But the New York Fed guy always gets to vote because he's in charge, or she's in charge of OMOs and foreign exchange. Okay. So, anyways, an open market operation means they go into the open market, bonds just floating around, finding discovery of price and yield. And the Fed goes in as a buyer or a seller into the open market, and they influence by buying and selling bonds. So if the Fed says, you know what, we need to cut interest rates by 50%, what they mean is they're going to go into the market, the open market, the same market you and I buy in. So if you called up your bank and you said, I want to buy a bond or a treasury, they go to the open market. You have to be a bond dealer, but it's just the open market. This is not like a special market. This is the same market that anyone in the world with money can access. Foreign governments and all that kind of stuff. And you can buy a U.S. Treasury. Cool. So anyways, the Fed goes into this open market and they're like, okay, we are going to drive interest rates down. Now, you may know that interest rates and prices have an inverse relationship. If prices go up, prices for a bond, if prices go up, then yield or interest rate, I'll put interest rate goes down. I can explain this, and I don't know if this is the right time to talk about it. I mean, maybe it is, I don't know. But anyways, if prices go up, interest rates go down. So how do you get prices to go up? Are you a buyer or are you a seller? How do you drive prices up for anything? Drive prices up on an auction, for example. By the way, these are auctions. No. Don't say cheap money. We're talking about money, Jimmy. How does the Federal Reserve Bank of the United States drive up bond prices to lower their yield? It's an auction. The way you drive up prices is you start a bidding war. You buy, and you buy and push the prices up. Okay? So that means that the Fed would go into the bond market, right, in the open market, and their operation would be buy bonds. The more they buy, the higher the prices go, and the lower the interest rates. Now, here's what happens. You have to be a bond dealer. So JP Morgan is one of the few, Morgan. Okay, JP Morgan is one of the few big banks in New York. That's why the Bank of New York for the Fed is there, because that's where the big banks are. And what is there, 12 or 14 bond dealers? It's very small, okay? So anyways, so this is how it works. Jerome picks up the phone. Hey, JP, it's JP. You get it? JP Morgan, Jerome Powell. Right? It's actually Jamie Dimon, right? Hey, Jamie, it's JP over at the Fed. I want to buy some bonds, yo. That's how you do it. Give me some bonds, yo. JP's like, okay. Okay, so anyway, so here's what happens. JP Morgan is sitting on bonds, and the Fed wants to buy these. So what does the Fed have to do to get JP Morgan to transfer their bonds to the Fed? What does the Fed have to do to get JP Morgan to transfer bonds to them? Pay! With what? Money. So the Fed, they go to the computer and they go click, 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 and they invent some money. You know how, have you ever heard that the Fed just prints money? No, the Treasury prints money. The Fed goes click, 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 and they invent some money. They invent it. They just create it. They send the money to JP Morgan. Okay? So the bonds disappear and the money goes here. And then the bonds go here and the money is gone. Okay? Cool. So now the Fed owns the bond and JP Morgan has the money. The money didn't exist earlier. Do you remember that? The Fed created it. So now it's in JP Morgan's bank account. It's in the vault. And I'm not going to go into the fractional reserve, the fractional nature of banking and everything, but that money is actually multiplied. So right now, for every dollar the Fed sends to JP Morgan, eventually $10 goes into the economy. And that's the part, right? That's the part I wanted to point out. That money didn't exist before. The Fed actually just created it, clicked a couple of clicks on the computer and just ones and zeros electronically. They didn't print a bill. They just create the money, send it to JP Morgan. They remove the bond from JP Morgan, so they buy the bond. And JP Morgan now has money that didn't exist. Now, it's in the JP Morgan's bank account, but what do? Then they loan it out. Well, actually 10% of it, right? Some of this goes back to the Fed as a deposit, and the rest gets loaned out. So when you get a loan, you spend the money and you buy something, and then that money gets sent to somebody. 10% of that gets sent to the Fed, and the other money gets purchased. They purchase something with it. The asset changes hands, and the money goes somewhere else, yet to another bank, and then to another bank, and then to another bank. And like I said, as this continues, at the end of the day, the money didn't exist. But by the time it goes from bank to purchase to bank to purchase to bank to purchase to bank to purchase, all the way down until there's like 5 cents left, that dollar that didn't exist before, so let's say this was $1 billion, by the time the fractional reserve system's done, and by the way, the formula is 1 over R plus E. But anyways, that's called the money multiplier. So by the time it's done, 10 billion now has entered the market. Money supply has increased by 10 billion. If the Fed purchased 1 billion worth worth of bonds from JP Morgan. That's amazing, right? Well, is it quantitative easing? Sort of. At some point it is, but in this case it's not. All they're doing is adjusting interest rates. And how do they do that? By growing or shrinking the money supply. So this goes all the full circle now. What the hell does this have to do with the trade war? Oh, thank you. Your fundamental course on FX Bootcamp about money is the greatest, to be honest. Well, thank you. This would have no bearing, no impact at all on a trade war. Now, if the economy had slowed down because people were losing their jobs, and people were losing their jobs because everything was overvalued and all that kind of stuff, yeah, then maybe. But that wouldn't do anything. So it goes all the way back. Do you think the Board of Governors and the 12 presidents of the Federal Reserve banks and all their staff and all their PhDs and quantitative analysts, do you think they understand at this level that I just showed you? Right? Because this is like kindergarten, right? Like I'm using crayons to explain this. This is crayon economics, right? Do you think the Fed understands at this level, or maybe even at a higher level, of what monetary policy does? Well, if the answer is yes, the people in charge of the Fed in the United States understand at this level, or even maybe even at a better level, a higher level, then they would not cut interest rates. You know what I mean? So I think the bigger thing here is that what if Jerome Powell does signal a cut? Then he's not doing it for, let's say, the textbook reason, or even the logical reason. Okay? It's interesting, right? And you see how dangerous it is, though, too? If the Fed put $1 billion in, it creates a $10 billion change. That's a big deal. So how much money would it take now to lower interest rates in the United States by at least 50 basis points? Oh my God, 2 rate cuts? Okay. Now, does anyone have a sort of a fuzzy understanding of why prices and interest rates would be inversely related? Well, South Africa has different problems, right? Right. So when you say in South Africa, certain politicians, blah, 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 blah. South Africa creates its own problems. I'm really, really sorry and sad to say. You know that? I don't think it's a coincidence that 2 of the nicest, smartest, hardworking, and honest people I've ever met in my entire life, even though I've traveled the entire world, are from South Africa. Do you understand that? Like, so when I think of South Africa, I think of all the amazing characteristics of that country, and there are many. And then I get pissed off because then there's South Africa. So anyways. Oh, I'm not going to go into South African politics. I'm not even a South African, so I can't get into it. But it seems like, how do you say in English? The government doesn't help. Let's just put it that way. I'm an outside observer. I don't follow South African politics, and he said and she said and they did this, but here's the straight up thing. South Africa should be a leader in the world. You understand? It should be a leader in the world, and it's not. All right, so let's just move on. We have a lot of South Africans here. I'm not picking on South Africa. So what the heck were we talking about? Yeah. Oh, yeah. Why are prices inversely related? Amelia, that's easy. It's risk off. People are taking money off the table going into summer. That's straightforward. Okay. It's hard. Hey, dude, would you stop posting that crap, please? Okay. The DPTP 20K. Just stop it, all right, please? Gee whiz. Why do people even get out of bed to, like, waste time of 150 people that are trying to change the world? Like, what crap? People have such useless, worthless time. Anyways, do I trade Bitcoin? Like I said, I've probably only done 50 or 60,000 this year. So it's a very small thing. So I can't say I'm a trader per se, but I'm very interested in it. Not necessarily for trading, but for other reasons. But anyways, okay. Should I go into bond prices and yields, or should I just go into? See, the thing is, today with the Fed meeting coming up, I don't want to look for new trades. I'd rather just hang with you and talk about big picture stuff, right? Oh, just Coinbase. Okay, I don't use any leverage and all that kind of stuff. I think my first Bitcoin was at 3,800, and then I bought another, and then I bought another, and I bought another. I think when it was 3,800, I bought $20,000 worth. So what was that? Yeah, about a few, anyways. Not big money though. Sorry, I'm stretching. I'm tired. Okay. All right. So let's put it. I can go from different points of view. So let's do it this way. We talked about prices going up with supply and demand, right? Okay. So let's do it this way. Here's demand. Here's supply. Supply 1, demand 1. Okay. So let's say you want a loan. Okay. And how much would you be willing to pay? You're willing to pay market price. That's the cool thing, right? You're willing to pay market price. You're not willing to pay too much. You sure would like a cheap deal, but at the end of the day, you're going to get the market price. Okay? If demand is low, we'll put your prices, or let's say percent. Okay? If demand is low, let me redo this one. This. Okay. Okay, so this is interest. Okay, cool. All right. So if demand is low, I wonder if I should do this from the other point of view. Well, let's just establish the basics. Okay, if demand is low, prices or your cost, whether it's a price or a yield or whatnot, they fall. Okay, or if supply is low, you pay high. You see this? Okay, so what if you're trying to get a loan, but the supply of loans is low? You pay more, is all I'm trying to say. You're going to have to pay more. All right, so let's go back to an auction. You go out to the global market and you say, okay, I need to borrow $1 million. Okay. You need to borrow $1 million. Cool. And you're like, okay, I am willing to pay 4%. Okay? For 30 years. Kind of looks like a mortgage. This is a bond. Bonds are just cash flows. Essentially, that little piece of paper that says you own a house and you're willing to make payments for 30 years, that's an asset-backed bond. If you don't pay the bond, they take your house away. Okay, it's a cash flow. So anything could be monetized that way, okay? So this is your loan for your business, for your house, whatever. What are you going to have to do to convince people to give you this loan if nobody shows up with the money? You make an offer now. You're like, hey, world, I will pay 4% a year for 30 years if you give me $1 million. What are you going to do if nobody shows up and gives you the money? Offer something else. You're like, hey, world, all right, how about 5%? Yeah. Nobody shows up. Now what? How about 6%? Okay. You're offering money now. Loan me the money. I'll give you 4% return. Nobody shows up. Okay, well, I'll give you 5% return. Nobody shows up. Okay, I'll give you 6%. All of a sudden, someone shows up and says, okay, I think you're a little risky here and all that kind of stuff, but at 6%, I'm willing to accept the risk. And I've looked at my other opportunities of loaning out my money, and yours is just good enough for me to consider you the best deal. So I will loan you the 6%. Okay. There's another way of doing this, by the way. Okay. What if you priced it this way? What if you said, okay, the $1 million, I will lend you, well, so you need the million. So let's do it this way. I will lend you $1.4 million. Okay, or to say it differently, you will owe me $1.4 million, but I'm only going to cut you a check for $1 million. It's just a cash flow. It's the opposite. Okay, and right, or you offer that, loan me $1 million, and I will pay you back 1.4 million. Nobody shows up. Okay, lend me $1 million, I'll pay you back 1.5 million. Okay. All right, so you want to look at it, those are two different ways of pricing, because like the smaller ones are like that. Okay, you lend the government $999.92, and at the end of the year they pay you $100. There's no interest rate on a note that way. Okay. Now, I don't think I quite explained that well enough, so I'm trying to think of another analogy. But I'm trying to tie in the open market operations. And there's also there's a technical way of describing it when you look at, so what is this? Present value is equal to future value over, what is it? One plus, what is it? 1 plus I to the n. Is this right, guys? Does anyone remember that? So the present value, so the present value, what a bond is worth, okay, is tied with how long, so n is the how long the loan is. This could be months, it could be years. And I is the interest rate. Okay. So what something is worth now has to do with a lot of these things like interest rates. So if you own, let's say you bought a bond now. You're going to buy a bond. A 10-year T-note. Okay? 10-year T-note. Doesn't that sound great? You've seen them traded. You're going to buy a 10-year T-note. Okay? What does it pay right now? Let's dumb this down. I know it pays less than this, but let's dumb this down. You're going to buy a 10-year T-note, and for 10 years, it's going to pay you 2%. I know it's more like 1.86 or something, but let's just dumb this down. So every 6 months, you're going to earn half of the 2%, so 1%, right? So you're going to earn 2% a year. Let's just say it that way. You're going to earn 2% a year every year for 10 years. And then at the end of the 10 years, you get your money back. You are literally the bank to the United States. Okay? What happens if the Fed cuts interest rates this year to 1.5? Okay? So that all new 10-year T-notes pay 1.5%. First of all, does the yield you're earning, does that change? Does that change? Like you were earning 2, but then the Fed cut interest rates, so now you're only earning 1.5? No. You earn the 2%. This is a contract. This is a contract. You will earn 2% a year on your 10-year T-note for 10 years, and then you get your money back. Okay? That's locked in stone. Then the Fed comes in and cuts interest rates. And new 10-year T-notes, if someone wants to loan the government money, the government only pays them 1.5%. But it's a guaranteed contract. But here's the cool thing. Let's say you change your mind and you're like, you know what, I'd rather have my cash. So you could sell your 10-year T-note in the open market, just like the Fed. You have to do it through a dealer, so you call up JP Morgan and you're like, sell my bond for me. They're like, yeah, cool. And they call up to the trading desk and it's done. Okay, here's the thing. Let's say this is worth $10,000 plus 2% a year. But now, so you're the seller. Now imagine a buyer. The buyer walks into the market and he says, okay, what are they paying? Well, all new issues, right? All fresh cut, new issue bonds, 10-year T-notes are paying 1.5%. However, the bond dealer says, we have a client that's selling a 10-year T-note that is paying 2%. Which one do you think has a higher price? The one that will pay you 2% a year every year for 10 years and then give you your money back? Or 1.5% every year for 10 years and then give you your money back? Which one do you think is worth more? Yeah. So that's another way of looking at it. So let me illustrate this. Let's illustrate this a little bit further. So what happened over the course of time? Interest rates fell from 2% to 1.5%. The Fed cut interest rates. Okay? But what happened to prices? I drew this upside down, right? So you have to be careful. I hope I'm not confusing you. Prices went up for the 10-year, this one. Prices went up for this one. As interest rates fell, this one became more and more valuable. Now I kind of regret drawing it upside down, but I didn't prepare this speech in advance, right? But you see how prices went up for this as interest rates fell? Now, you would actually pump this into the formula. The present value is equal to $10,000 plus, $10,000 over 1 plus the interest rate, okay, 2%, over the period, over 10. Okay, so what if there was only 9.5 years left on this and a full 10 years on this, because this is fresh cut? You can actually adjust it, and you do this instead of 10 years, you do it in 120 months, and you can do all that kind of stuff. And you can get to the exact penny what this is worth. And then you can do the same thing to find out what this is worth. Okay? And then find out, well, this one is worth more month over month, right? What if there was only 8 years left? Well, you do it in that, and you'd still come out. So this is finance now. You can just do some basic calculations, and I can tell you exactly what it's worth. Now, the debate here in your modeling is like, what is I? Is that the Fed funds rate? Is that the prime rate? Is it the opportunity cost? Like, for example, if I was a bank trying to decide, should I invest them? So like a bank manager has, their job as a bank is to deploy capital, right? They have to pay for the deposits, but once they all have that, then they have to invest the money to earn a profit, right? So they have a choice here. The bank manager can say, well, I can buy this 10-year T-note paying 2%, okay? Or I can lend them, I can issue a mortgage, I can lend against a house and earn 5%. So what's the opportunity cost? The opportunity cost might be 5%, and you're like, I don't want to do this deal. But whatever. You can actually just do the numbers and figure out what the value is. So if you want, you can actually do the calculation. The future value, $10,000, because in the future you're going to get $10,000 back over 1 plus I to the n period. Okay. But what I'm trying to show you, as interest rates fell from 2% to 1%, the price of the actual bond. Now remember, there's an auction here. You might have to pay $11,000, let's say, to make this simple. You might have to pay $11,000 to buy a $10,000 bond. Yeah, no joke. It happens. You're like, well, why would someone pay $11,000 for a $10,000 bond? Do the math. Okay, it's called the time value of money. And this is an important concept if you're going to be a bond trader, because that's what this is all about. Bond trading is very susceptible to this. Okay, now you can see some of this at work. So like I was saying before, sometimes the market doesn't offer a yield. You can lend, well, like the Fed funds rate. What that's actually used for is Bank 1, well, let's say Bank A is lending money to Bank B. Okay? It's not an open market. Bank A is lending money to Bank B. This is the Fed funds rate. And it has to do with short-term cash flows related to depositing money at the Fed. That's why they call it the Fed funds rate. At the end of the day, every day, a bank manager looks at all the transactions, the amount of deposits, the amount of withdrawals. And if they've gained money, some of that money has to be parked at the Fed. But what if you loaned out so much of your money to mortgages that you don't have any money left over? Or what if you have a big withdrawal? One of your big clients says, I want my $1 billion back. And you're like, you have to give it to them. It's an at-will sort of relationship. It's a liability to the bank. So your client comes in and says, give me $1 billion. I'm going to buy something, right? So you give them the $1 billion back. You have to. But what do you do if you got all that money locked in 10-year bonds and 30-year mortgages? Where do you get the cash to cover the $1 billion if you've invested all that billion now in long-term debts? Well, in this case, assets, long-term cash flows. So like you own a portfolio of performing assets that every month pay you some money. Commercial real estate loans, residential real estate loans. You've bought bonds, maybe not corporate bonds, but certainly treasuries, government bonds of all different maturities. But you have to give the guy the $1 billion when he asks for it. So what do you do if you've invested long, but now you're short on cash? You go to the Fed funds rate. You just borrow the money. Okay. So the way that this works is the banks, you buy something for $999.92, but you will be paid back $1,000. Okay. This might be in 24 hours. This might be in 30 days, for example. You see what I mean? You're like, it's not a lot of money, but what if it was right? But whatever, you end up it ends up being fine. I mean, especially since you're not using the money anyways. This is excess reserves going to cover required reserves. Okay? From bank A to bank B. So how does that work? Well, we can actually pull this up. Boy, we really went long today, huh? Didn't even look at a chart. I hope this has been okay. Like I said, this is not a good day to like start getting into trades. If you haven't planned out your whole entire week, then putting me into a trade right before a Fed meeting is just ridiculous. So anyways, Fed Funds Watch. Wow, that was crazy, huh? That's funny. Okay. This is interesting because now we're looking at institutional investors lending institutional investors money. These are short-term loans from JP Morgan to Bank of America and Bank of America to Capital One or Chase or whatever. Okay. Wells Fargo. Okay. And here's the dates when the loans are essentially due, right? June 19th. Then there's a July. Let me accept this. Okay. There's a September, October. You notice this is lining up with Fed meetings. Target rate probabilities of September 18th, 2019. Okay. And based on what's going on in these markets, these probabilities, 44% probability right now that by the time we get to August 30th, interest rates will be at 1.75. Some people, almost 25% of the market, think it'll be closer to 150, 1.5%. Fed funds rate. Now, this is done by looking at the prices that these banks are negotiating with each other. So when one bank loans money to another bank, they're institutional investors. They know what they're doing. They know what's going on. They're the smart money. And they're negotiating deals with each other. And since these are deals that might go as long as a year, you have to, let's do it again. In your calculation, you say, okay, we need to borrow money or we need to lend money. And so what is the present value of a loan, okay? Right? And you start doing your calculations. Okay? You start doing your calculations. So what are these bonds worth? Okay? If I loan somebody my money based on right now, what is this investment, this loan? What is this loan worth to me right now? So if I loan somebody $10,000 or 10 million or 10 billion, okay, that's the $10,000. But that value over time, like I have opportunities. I have other things I can do with this money. But one of the things that's going to affect, right, obviously how long I loan the money, because the longer I loan the money, or the longer the period until I get paid back, the higher the risk because you might have better opportunities. But what if over the course of the year, the Fed changes its interest rates? That affects I. And so now you have to say, well, I think they're not going to cut in the June meeting, but I think they're going to cut in the October meeting and maybe even the December meeting. So if I'm going to lend you money, I have to calculate I falling in October and then again in December. Now, it's just an opinion. And someone else will say they're not going to raise in October, but maybe December. And other people will say they're not going to cut at all. And other people might say they might cut it multiple times. As we can see, the opinions are right here. These are the opinions. Some people think they're going to cut all the way to 1 1/4. Some people think they're going to raise interest rates, right? And almost 100% of people will think, well, it'll be where it is now to maybe significantly lower, right? They get to these percentages based on the actual prices negotiated. And then you can look at how things change. A lot of people think we'll be at 175 by the time we get here to December, but a significant amount of people think it will be at 150. So 2 cuts, very likely, according to this, and so on and so forth. So when one analyzes the price for today, and then the next price for the July note, right? And the next one for the September, and the next one, and you're looking at all the different prices being negotiated. Remember I said someone might lend $9.9 to receive $10 sometime in the future. And if you thought things were going to change, you might only loan 9.8 to get your $10 in the future, right? You might have to say, you're going to have to compensate me more for the risk, or even less for the risk, depending on if you thought interest rates were going up or down. So this Fed Funds Watch tool is something that professionals watch to try to figure out the probability of what the Fed is doing. Now, this has nothing to do with the Fed. This is not a survey. This is not the CME group going to bond dealers like, tell us what you think. Where will interest rates be in 6 months? And they'll say, well, that's a really good question, Ed. And, blah, 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 blah. The interesting thing about this is it's looking at the price differential over time between deals that institutional investors are making with each other. And from that, you can derive, because it's only finance. Finance is great. It's much closer to it's math. It's like the engineering of money. So you just look at it and say, well, to get to that price, these assumptions were made. That's the wonderful thing. You can reverse engineer it. So why would someone pay why would someone loan out $999.92 to receive $1,000 in the future? Oh, well, they assumed a change here, but not a change there. And boom, 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 you can figure out exactly what was negotiated. So when you take up all these deals being negotiated over the course of time, and the differential in the prices that were actually negotiated, because remember, CME Group is an exchange, so they do these deals over the exchange. You can reverse engineer and extrapolate from all the math what they negotiated. And for this October 30th loan, 44.4% of the deals were assuming a rate cut by October. But 24% of the deals assumed 2 cuts by October. That would be one in June and another one in October, or 2 in October, which is like, who thinks that? Really? But anyway, somebody negotiated deals based on this. And that's what I like about this. And again, this is prices going up and yields going down, or yields going down and prices going up, and all these different things. Lots of different interesting angles when you understand monetary policy. But I'm going to end it with this, by the way. What the hell does any of this have to do with the trade war? Are these institutional investors, are they negotiating, and are they worried about trade wars? And if the Fed cut interest rates and impacted this market, which they think they are, right? Then, so bond prices are going up. Bond prices are going up, pushing yields down, increasing the money supply of the United States dollar, which would weaken the dollar. And does any of this have any impact whatsoever on a trade war? Or is it a band-aid to help the economy out while the trade war is going on? But you know, housing prices are up, stock market prices are up, wages are up, and everywhere I walk around the American economy, there's help wanted signs. So are we really at a point where the Fed is going to cut? Well, they could. I mean, they could do whatever they want. And that'll make it a very interesting thing, because I'm not really buying the argument that we're in a scenario that the Fed should increase money supply. Oh, I'm sorry, lower interest rates. Of course, they're one and the same. So the Fed lowers our interest rates. What would that do? Well, I can borrow more money and buy the stock market, which is like buying the stock market on leverage, right? Or what? I guess I can get a cheap car lease, or maybe I can buy a house. But you know what the thing is? Mortgages are not that expensive right now. The number one problem in the real estate industry right now is supply. There's not enough good houses. So if we cut interest rates, is that going to solve that problem? No, but it will make mortgages cheaper. That's cool, I guess. And I guess credit card payments will fall a little bit, and car leases will fall a little bit. But if so that helps poor people, because poor people borrow money, right? Well, they borrow money for the wrong reasons. So let's say I'm a rich person, I own a factory, and I'm very, very concerned that my sales have dropped by 50% because of a tariff put on my product. And the Fed lowers interest rates. How much does that solve my problem? Or I'm a soybean farmer in Iowa, and the Fed cuts interest rates. All right, I guess I can borrow money to buy new equipment, or I can borrow money to improve the property, or the financing on the chemicals I have to apply is cheaper. So that's cool. But I have a field full of soybeans that nobody wants. See what I mean? So is it really the Fed to the rescue? I don't know. So we'll see what happens today. Remember how I started the session. I am a patient and disciplined trader. I only trade my long-term fundamental bias. I will not chase price. I will not guess. I am not a degenerate gambler. I am patient, I am disciplined, and I will not lose a lot of money today. Start with that. I think you'll just do fine today. So peace on earth. May the pips be with you. May our profits be above average. Cheers. Oh, and if you learned anything today, make sure you do the thumb up, okay? Or leave a comment or something. Get involved. Participate, huh?